This is Financial Freedom, where we unlock financial freedom one video at a time. In this video, you'll learn about 12 of the biggest mistakes that almost every investor makes, according to Warren Buffett. Now, I've been investing for over a decade, and I'll admit a few of my own investing sins along the way to be a good sport. This is Financial Freedom, bringing you the best tips and tools for reaching financial freedom through stock market investing. All right, so the first deadly sin of investing is trying to time the market. Many investors believe they can predict the highs and lows of the market, buying low and selling high to maximize their returns. However, this approach is fraught with risk and often leads to significant losses. Warren Buffett considers focusing too much on the general stock market a great mistake. He emphasizes that the market's short-term movements are unpredictable and trying to outguess it is a fool's errand. None of us actually know what the market will do tomorrow, next week, or even next year. The market is influenced by countless factors, from economic indicators to geopolitical events, and even the collective psychology of investors. Instead of trying to predict the unpredictable, Buffett says to focus on identifying high-quality businesses that are undervalued by the market. This approach, known as value investing, involves thorough research and a deep understanding of a company's fundamentals, and then just hold them for the long term. Patience is key in investing. By holding on to these undervalued stocks, you give them time to grow and realize their true potential. Over the long term, the market tends to reward businesses that can consistently grow their earnings. Companies that innovate, expand, and manage their resources well are likely to see their stock prices rise over time. Many people sold all their stocks back in March of 2020 when the market tanked, missing out on the huge rebound that followed. This panic selling is a prime example of the dangers of trying to time the market. The lesson here is this: don't try to time the market. Instead, adopt a long-term perspective. Understand that market fluctuations are normal and part of the investment journey. Instead, focus on buying great businesses and holding them for as long as they remain great. This strategy not only reduces stress, but also increases the likelihood of achieving substantial returns over time. The next deadly sin is getting emotionally attached to your investments. This is a common pitfall that many investors, both new and experienced, fall into. Many investors get attached to their purchasing price. They see the price they paid as a benchmark, and any drop below that price feels like a personal failure. I remember buying a stock at $20 a share, and then it went down to $15. It was a tough pill to swallow, seeing the value of my investment drop so significantly. I held on for dear life, not wanting to sell for a loss. The emotional attachment to that initial price made it hard to make rational decisions. The stock doesn't care about your purchasing price, only the future earnings potential of the business matters. It's crucial to focus on the bigger picture and the long-term prospects of the company. If the fundamentals haven't changed, there's no reason to sell just because the price has gone down. In fact, a lower price might present a buying opportunity if the company's future still looks bright. In fact, that's often the best time to buy more. When the market undervalues a stock, savvy investors see it as a chance to increase their holdings at a discount. If the fundamentals have deteriorated, you should sell, even if it means taking a loss. It's better to cut your losses early than to hold on to a sinking ship. Be objective and unemotional about your investments. Remember, the goal is to make money, not to be right about a particular stock. Keep your emotions in check and make decisions based on data and analysis. Another big one is expecting very high growth rates. New investors often project that a company will double or triple in size every year, but very few companies can sustain that kind of growth. Buffett points out that very few large companies can compound their earnings at even 15% per year over a long period. As companies get bigger, it becomes harder to maintain high growth rates. When evaluating a company, be realistic about its growth prospects. Don't get caught up in the hype. Focus on companies with a long track record of consistent growth and high barriers to entry. The fourth deadly sin is using too much leverage. Leverage can be powerful, but dangerous if not used correctly. Using a lot of leverage is like playing Russian roulette. If you buy a stock with 100% margin and it goes down by 50%, you've lost all your money. If it goes down further, you'll owe your broker money. Use leverage sparingly and only when you have a high degree of confidence in your investment thesis. Understand the risks involved. Deadly sin number 5 is missing the forest for the trees. This phrase is often used to describe a situation where someone is so focused on the details that they lose sight of the bigger picture. In the world of investing, this can be a costly mistake. Many investors get caught up in day-to-day market fluctuations and lose sight of the bigger picture. They become obsessed with the minute-by-minute changes in stock prices, constantly checking their portfolios and reacting to every little dip and rise. They focus on short-term earnings reports and analyst ratings, ignoring long-term fundamentals. This short-sighted approach can lead to poor decision-making and missed opportunities. Instead of looking at the overall health and potential of a company, they get bogged down by temporary setbacks or minor achievements. The stock market is forward-looking. It cares about the future, not the past. Investors need to adopt this mindset and focus on where a company is headed, rather than where it has been. By doing so, they can better position themselves to take advantage of future growth and opportunities. Constantly focusing on the short term means missing out on big opportunities. When investors are too concerned with the immediate future, they often overlook the potential for long-term gains. This can lead to a cycle of stress and poor investment choices. The mistakes are always about making an improper assessment of the economic conditions in the future of the industry of the company. Investors need to look at broader economic trends and industry forecasts to make informed decisions. This requires a deep understanding of the market and the ability to see beyond the present moment. They're not a bad lease, a specific labor contract, or a questionable patent. These are just small pieces of a much larger puzzle. Investors need to consider the overall strategy and long-term vision of a company. Focus on the long term and see the forest for the trees. By keeping an eye on the bigger picture, investors can make more strategic decisions that will benefit them in the long run. Don't let short-term noise distract you from long-term goals. Stay focused on your investment strategy and remember that true success comes from patience and a clear vision of the future. Deadly sin number 6 is jumping over 7-foot bars. Many investors try to get too cute with their investments. They look for complex, obscure businesses, thinking they'll find a hidden gem. But investing doesn't have to be complicated. In fact, the simpler, the better. Some businesses are easier to understand than others. Simple ideas yield exceptional results in the long run. Don't try to be a hero. Don't try to jump over 7-foot bars. Focus on finding simple businesses that you understand and that have a long track record of success. A deadly sin number 7 is shrinking your universe of opportunities. Many investors get comfortable in a certain sector and refuse to look elsewhere. They become experts in one area and think that's all they need to know. But the world is constantly changing. New industries are emerging all the time. If you're not willing to adapt, you'll get left behind. Don't be afraid to step outside your comfort zone. Learn about new industries and businesses. Keep an open mind and expand your universe of possibilities. Deadly sin number 8 is staying active all the time. Many investors think they need to constantly buy and sell stocks to make money. They're always checking their portfolios and looking for the next big trade. But the more you trade, the more commissions you pay. And the more commissions you pay, the less money you make. Be patient and wait for the right opportunities. Don't feel like you need to be constantly trading. Sometimes doing nothing is the best strategy. Wait for the fat pitch. Deadly sin number 9 is diversifying too much. Diversification is good, but over-diversification isn't. If you own too many stocks, you can't keep track of all of them. And if you can't keep track, you can't make informed decisions. Most investors can probably get away with owning between 10 and 20 stock. Focus on quality over quantity. Know your investments well. Deadly sin number 10 is confirmation bias. It's the tendency to seek out information that confirms our existing beliefs and ignore contradictory information. This is a costly mistake for investors. For example, if you're thinking about buying a stock, you might only look for positive information. You read positive analyst reports and talk to friends who own the stock, but you ignore negative information. This gives you only half the story. Be aware of confirmation bias and try to avoid it. Actively seek out information that contradicts your beliefs. Get the full picture before making decisions. The 11th deadly sin is following the herd. This mistake is easy to make, especially with social media. Humans get fearful when others are fearful and greedy when others are greedy. You see people buying a stock, so you think you should buy it too. Or you see people selling, so you think you should sell. But the herd is often wrong. Don't be afraid to think for yourself and go against the herd. The 12th deadly sin of investing is mistakes of omission. Sometimes the biggest mistake is not doing something. I've often done research on a company, concluded it's a great investment, but then didn't pull the trigger. I got cold feet and missed out on the opportunity. These are mistakes you can't go back and fix. You can't go back in time and buy that stock. If you've done your research and believe in a company, don't be afraid to invest. Don't let fear hold you back. Take action when you have conviction. So there you have it. Those are the 12 deadly sins of investing, according to Warren Buffett. I hope you found this information helpful. If you did, please hit that like button down below. Share your own investing experiences in the comments. If you want to hear more about Warren Buffett's most important investments, check out this video. Cheers, guys.